Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda. Welcome to the overly complicated topic of derivatives. Today, we'll demystify derivatives and explain their purpose using simple language. So, let's dive right in. What are derivatives? Let's start by understanding what derivatives are. Derivatives are financial instruments that derive their value from an underlying asset. They are like contracts or agreements that allow investors to speculate on or hedge against the price movements of something else, such as stocks, commodities, or currencies. To simplify, think of derivatives as side bets. You're not directly buying or owning the asset itself, but making a wager on its future price. Imagine you want to speculate on the price of gold. Instead of buying physical gold, you can use a derivative called a futures contract to bet on whether the price of gold will go up or down. Types of derivatives. Now, let's explore some common types of derivatives. Futures contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price on a future date. These contracts are often used by investors to speculate on the price movement of commodities like oil, gold, or agricultural products. Suppose you believe the price of oil will increase in the future. You can enter into a futures contract to buy oil at a specific price, locking in that price even if it rises in the market. Options contracts. Options give the holder the right, but not the obligation, to buy or sell an asset at a specific price within a specific time period. They provide flexibility to investors who can choose to exercise the option or let it expire. Let's say you own stock in a company, but you're concerned about a potential decline in its value. You can buy a put option, which gives you the right to sell the stock at a predetermined price within a specified time. If the stock price does fall, you can exercise the option and sell your shares at the higher price, protecting yourself from losses. Swaps. Swaps are agreements between two parties to exchange cash flows or other financial variables. They are often used to manage risks, such as interest rate or currency fluctuations, by exchanging payments based on predetermined conditions. Imagine a company with a variable interest rate on its loan. To protect against rising interest rates, the company can enter into an interest rate swap, agreeing to exchange fixed interest payments with another party. This helps the company manage its interest rate risk. Purpose of derivatives. Now, let's discuss why derivatives are used. Derivatives serve several purposes. Speculation. Some investors use derivatives to speculate on the future price movements of an asset. They hope to make a profit by accurately predicting the direction of the market. Traders may use options contracts to speculate on the price movement of a particular stock, aiming to profit from anticipated price fluctuations. Hedging. Derivatives can be used as a risk management tool. They help investors mitigate potential losses by offsetting risks associated with the underlying asset. Airlines often use futures contracts to hedge against the risk of rising fuel prices. By locking in a specific price for fuel in the future, they protect themselves from potential price increases. Price discovery. Derivatives markets provide a platform for buyers and sellers to trade and determine the fair market value of the underlying asset. This price discovery process contributes to efficient markets. Commodities futures markets, such as those for corn or wheat, enable farmers and buyers to establish fair prices for their produce well in advance. Risks of derivatives. It's important to be aware of the risks associated with derivatives. Derivatives can involve significant risks due to their leverage and complexity. Here are a few risks to consider. Volatility. Derivatives are sensitive to changes in the value of the underlying asset. If the market moves against your position, it can result in substantial losses. Counterparty risk. Derivatives involve agreements between two parties, and there is a risk that one party may not fulfill their obligations. This can result in financial loss if the counterparty defaults. Complexity. Derivatives can be complex and require a good understanding of their mechanics. It's essential to educate yourself or seek advice before engaging in derivative transactions. That wraps up my guide on derivatives. We've learned that derivatives are financial instruments derived from underlying assets, such as stocks or commodities. They can be used for speculation or hedging, but they also come with risks. Remember to carefully assess your knowledge and seek professional advice if you plan to engage in derivative trading. Thank you for watching. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.